next up, we have Lionsgate Studios. Lionsgate Studios is one of the world's leading standalone, pure-play, publicly traded content companies. It brings together diversified motion picture and television production and distribution businesses, a world-class portfolio of valuable brands and franchises, a talent management and production powerhouse, and a more than 20,000 title film and television library, all driven by the studio's bold and entrepreneurial culture. As many of you know, the company recently completed its full separation from Starz and began trading independently under the ticker Lion on the NYSE. The company has about 286 million shares. It closed at around $7 yesterday for a $2 billion equity market cap, $1.5 billion or so of net debt for a $3.5 billion total enterprise value. I'm very pleased to welcome the leadership team from Lionsgate Studios. We have Vice Chairman Michael Burns, Chief Financial Officer Jimmy Barge, and Investor Relations Nilay Shah, for what should be a timely and insightful conversation. So we can go ahead and jump into this. So to kick things off, for those newer to the story, how has Lionsgate Studios evolved over the last decade into the standalone studio it is today?
Well, there have been a lot of steps to that process. We used to be a pure play content company. Bought Starz a number of years ago, which seemed like a good idea at the time. We launched international, didn't go particularly well. So we retrenched and then came to the conclusion that we're much better off being a standalone studio content machine. So we've just completed the separation of Starz, which is a separate public company under the symbol STRZ, and Lionsgate, which is on the New York Stock Exchange under the stock symbol Lion. So we've just completed that, and now we're going to go out there and market the story of Lionsgate as the pure play that we once were and will be going forward.
That's helpful. Can you touch a little bit on the strategic rationale behind the split from Starz and how you expect that to unlock value for Lionsgate?
Well, it hasn't done it yet, but it's early. We believe that Starz would trade at a different multiple than a pure play content studio. So it was just math for us, which is we believe that when we start firing on all cylinders again, and we think our slate is terrific. We told them we're going to be backloaded in 26 and 27. Looks like a solid year based upon the slate that we have with our feature films, and the television business is picking back up nicely. And library has always been a great asset for us, and we're very excited about what's going on there. We can talk about that later. But we thought that 1 and 1 was going to equal more than 2, and that's where we think we're going to end up.
That's helpful. What does the commercial relationship with Starz look like going forward? Have the optics of the separation help you win any new business or change how other platforms view you as a supplier?
Well, we have the pay one deal with Starz, a number of years left on that. So we have, I'll put it in the cousin category. So we're not one company any longer, two separate public companies, but we have the pay one window with Starz. They buy a license, a bunch of library product for us, so we can believe that we'll continue to see that relationship enhanced. I'm also the non-executive chairman of Starz.
That's helpful. So now that you're officially operating independently, can you just touch on Lionsgate Studios' go-forward strategy and how the new structure helps better position the studio in today's content and distribution landscape?
Well, we're very focused on just our content business. Mm-hmm. We also have a management company. We enhance the cash flows for the company because we've invested close to $20 billion in content over the last 20 years, and that includes the acquisitions. That's carried on our balance sheet at like $1 billion. So it's like one of these assets that never perishes. So think of it as an oil well that never runs out of oil. So our library, we think, is our greatest asset. We think it's sort of overlooked, even though we talk about it a lot. But it's a very solid margin business, $900 million in revenue the last 12 months. And it's the gift that keeps on giving.
Thanks. That's helpful. So talking a little bit more about the content strategy and pipeline, you've clearly doubled down on major franchises like John Wick, Hunger Games, Twilight, and more. How are you thinking about balancing tentpoles with mid-budget content?
We like to make money on all of our product. You don't always make money, but we certainly don't deviate from our model. We got stuck on a movie Borderlands, which is a cursed word around here. We got stuck in COVID land and strikes and all of that, and so that really made us make the mistake of stepping outside our model. Some of it was beyond our control, but we can make a lot of money on mid-budgeted movies, like for example the Mel Gibson directed Flight Risk, very solid win for us. And then we'll take some bigger swings. As you know, our portfolio has, we just announced we're doing a Resurrection with Mel Gibson, which is the follow-up to Passion of the Christ. So we have high hopes for that. Michael, we've talked about, there's a bunch of chatter about whether it be one or two movies. We won't specifically talk about that. But we think that is an unbelievable potential hit for us. And then Now You See Me, we've wrapped that. We've got a rough cut of the third Now You See Me. That looks terrific. And then we've got a lot going on in spaces that we're very comfortable with, meaning that 20, 30 to $40 million movies. For example, we have this movie called The Long Walk, which we did with Francis Lawrence before he started casting the new Hunger Games, which he's doing now. The Long Walk was a very, very modest budget. And so that's the kind of thing that we can make an awful lot of money if it really works.
Mm-hmm. No, you won't comment on the Michael Jackson project being one or two films, but can you just touch on how we should be thinking about timing in general for that and Resurrection, as well as the financial exposure for these two major projects?
Big budgets, a lot of money from outside sources, including foreign pre-sales. So again, fairly risk mitigated for us. Don't know whether it's one or two movies. We'll let you know when we know. I know there's 3.5 hours of footage on that project, which is terrific footage. Great director in Antoine Fuqua. So we're excited about the prospect. I think it's also we've talked about Resurrection, whether that's going to be one long movie or two, and stay tuned on that.
We definitely will. And then on the television side, you've noted strong renewal activity and episodic deliveries across series like The Rookie, Ghosts, and Yellow Jackets. How are you navigating continued pressures on buyer budgets and platform rationalization?
We shoot around the world. We shoot when appropriate. We also take advantage of subsidies in the United States. We're very encouraged by the results for The Rookie. That was part of the U1 transaction. I think that was the third highest rated show last week. Ghost is a big hit for CBS, and so we're trying to keep the budgets in line, have the shows go as long as possible, make sure that we maintain that we pick up some rights, even when it looks like it's a cost plus deal. We typically keep rights as well. And very excited about, again, you don't want to jinx it, but we think that the studio has got a lot of heat and might be an award contender. And if you haven't seen it, it's worth seeing. It's on Apple.
Great. And then can you touch on how 3 Arts fits into the broader Lionsgate strategy going forward? I had this question prepared, and then we also got an audience question about it as well, just trying to better understand the rationale. And it looks like there's a lot of private equity money that's flowing into the creative agency businesses from there. So if you could touch on the value of this asset that you see.
We think it's a really valuable asset. It was, we bought in 50% 5 years ago, then we just bought another 25%. We have great relationship with all the partners there and all the young up and comers, the young Turks over there. We feel like we greatly enhanced their television business. At the same time, we think they helped our television business, and getting closer to talent was a very good idea. So we, as I said, we have 75% of it. Yes, the space has gotten very heated. I'm sure there's a lot of chatter about what we're going to do, and we're going to do what we think is always in the interest of our shareholders from a creative standpoint, and figure out ways that we can potentially monetize or consolidate or enhance the value of what we do and what the management company does.
That makes sense. And then can you also just touch on how you're positioning for growth in the creator economy and digital talent representation as well?
We are very much in the throes of that. I have a slide. I'm going to do CNBC, I think, on Monday. And I had one of our people here, Susie, one of our really smart executives, and I said, just take a movie and just tell me how many places were monetizing it. She took John Wick, and then she looked at Dirty Dancing, and then Twilight. And we have 19 different uh, paths to monetize that we're currently doing with, for example, John Wick. And I'm sure we have close to that on the other two movies that I mentioned. I called it, younger, medium, and old. So we, again, every day there's another new platform. It could be AVOD, it could be fast channels, it could be um, various forms of video on demand. DVD is still a business. We have it coming out later, probably later in the year. We have House of David, which will be on DVD. House of David is a show that we have some participation in. It's I think the number one or number two show streaming on Prime. And it's an Amazon show. We have some distribution rights, but my guess is the DVD sales on something like, and everybody says DVD must be dead. It's not. DVD sales in a place like Walmart, it's going to be very well received.
That makes sense. And then touching on dynamics in the market and kind of the potential for consolidation in the areas in which you operate, there's been renewed speculation about studio consolidation. How do you view the potential impact of further industry M&A, and how does Lionsgate positions itself amid those dynamics?
Well, we are, as you said, $3.7 billion enterprise value company. Stock's bouncing around, and we expect it to bounce around for a little bit. And it always bounces around before we have a big movie coming up, which we do. We have Ballerina. I'm bullish. We'll know soon enough. It's selling tickets tonight. It had large format, just one 7 o'clock show last night. Pretty pleased with how that turned out. And then, so it's going to bounce around on wide releases. We think that's a great extension of the John Wick universe. So consolidation, yes, there will continue to be consolidation and deconsolidation. And as I said, we're now a pure play content business. And we think that's attractive to be a buyer on the idea that we can save a lot of money on synergies and cutting costs. For example, the E1 transaction turned out to be a very good one that we recently did. Picked up some great shows like The Rookie, and also what's the Showtime show, Jimmy? I can't remember.
Yellow Jackets.
Yellow Jackets. So,
and Den of Thieves too on the film side.
Exactly. So we like the idea that we are one of the places that consolidate, particularly libraries, and we'll see how the rest of the consolidation in the space goes. But this was obviously something that we thought about in the separation of the two companies.
Mm-hmm. That makes sense. And then looking at kind of your customers and the overall landscape, with potential DTC consolidation on the horizon as well, what does a shrinking buyer universe mean for your TV production business? Are you seeing new categories of buyers emerge with YouTube, social, those sorts of players as well?
There are, yes, we're doing a lot on the short form. We started out the clip business, for example, at YouTube. We have, we're launching a couple different. We're not diving in with spending a lot of money, but we like that creator platform. We like what's going on, and the idea of monetizing some of our existing content, in places like TikTok and also on YouTube. Again, a lot of ways to get paid for every time somebody watches. Nobody puts baby in the corner. And whenever you have a new movie coming out, or we've announced the new Hunger Games, for example, all the old Hunger Games do exponentially better. With Ballerina coming out, it's got a big marketing campaign on that. We're seeing nice upticks on the first 4 John Wicks. So I have 3 kids that are Generation Z. I feel like sometimes they're being educated by YouTube and TikTok, but it's where the eyeballs are, and that doesn't escape us.
You touched on it a little bit in some of your earlier comments on subsidies, but there's been some chatter around tariffs on media production. What's your view on the regulatory landscape, and how does Lionsgate's global production footprint provide flexibility there for you guys?
Well, we chase subsidies. It could be states, it could be countries. But again, this is effectively all this content that we're creating is an export from the United States. So I understand the thinking about in some industries that the administration thinks that the country's being disadvantaged. I don't think that's the case in the film and television space. So we're, helping any way we can from an educational standpoint and have a strong point of view, as do the other studios.
Mm-hmm. You ended the year with leverage around 4.9 times when your fiscal year, you just shifted your fiscal year to be calendar year, but before that, and have guided.
I'm sorry, I want to correct you on that. Stars switched to a calendar. Lionsgate.
Apologies. Yes. Okay. So you still have your fiscal year ending in March, I believe.
Yes.
So you've guided to 3.5 to 4 times by the back half of fiscal 27. Can you talk about the roadmap to get there and your current priorities around cash flow deployment?
That's a great question for Jimmy. So Jimmy, you want to talk about the leverage?
Yeah, absolutely. And, we also noted on the earnings call that, as we separated on, May 6th, that the studio had about $1.65 billion of net debt. So on a pro forma basis, the 4.9 at March 31 kind of eased up to 5.5 times at the date of separation. And then, we're targeting at 3.5 to 4 times, as you noted, at the end of fiscal 27. The ebb and flow during the years is in 26. Cash flows in trailing 12 months are more back-end loaded, much like, we had an incredible finish in fiscal 25, our Q4, okay? And, 25 was a back-end loaded year, as is 27, moving in an incredibly strong growth into 27. And, the trailing 12 months, as it ebbs and flows, will, so will leverage. And, we like ultimately something closer to 3 to 3.5 times, but see the 3.5 to 4 times in sight in 27. And that's without any sale of any non-core assets or otherwise monetization that could further reduce leverage quickly. But we're well positioned. We have $800 million revolver and plenty of liquidity and nice cash flow streams as well. And Michael mentioned the $950 million trailing 12-month library revenues. That has about a 50% cash margin to it. So there's tremendous support financially for the company at these levels.
Mm-hmm. Can you touch on your expectations for content spending moving forward, and then also some of the other puts and takes on cash flow and conversion there as you reinvest in the content slate?
No, exactly. Thank you. We spend about $1.5 million-ish.
$1.5 billion.
Well, $1.5 billion, yeah, $1.5 billion. Maybe $1.5 million per episode, actually higher than that. But $1.5 billion on an annual basis, probably close to 50-50 split. It'll bounce around a little bit between motion picture and TV. So I expect pretty much that same level as we go forward. And I think on the free cash flow conversion, while the content spend will ebb and flow, it's really working capital, right? And so working capital is going to be a zero-sum game. It'll ebb and flow as you go through the year. But the only really other kind of pure reductions off of adjusted EBITDA is CapEx. We have minimal CapEx, almost no CapEx. Cash taxes. We have a great tax structure and $1 billion of NOLs approximately, and pay just minimal cash taxes. So very good profile there. And then the only other item is really cash interest, and that's very manageable. I do think rates longer term will be coming down. We're all waiting for that. But, and we've swapped some of that back as well to protect ourselves. So we got a, really a strong free cash flow generation. So it'll just ebb and flow with production spend and working capital movements as we go through the year.
That's helpful. And Michael, I believe you touched on, or maybe it was Jimmy, apologies, potential monetization opportunities that we were including those. Can you talk about any areas where you would see potential monetization opportunities for your business right now, as well as your appetite for M&A. I know Lionsgate gets a lot of attention as a potential target, but how do you think about M&A for the business as potentially a buyer as well?
We have, assets, non-core assets that we think are valuable. Some of them, call them tangential assets. We want to lower our leverage. We're committed to do that. We're not going to go out and buy stuff with our stock price. It's, $6.50, $7. That doesn't make any sense. And if we did, we should, you guys should fire us. So we're very focused on sticking to our knitting because we think we're in an enviable position. One, that we have plenty of capacity. For example, Jimmy talked about our undrawn credit facility, but you want us to make as much content as possible. You don't want us to make another Borderlands, but you want us to make as much content as possible, both on the television and the feature film side, because we make money on the vast majority of that content. So, but as far as your question, we're very focused on moving forward as a pure play studio.
That makes sense. I'm going to pause and see if there's any audience questions. We have a few here.
Hi there. My question is, I imagine that, Starz is still seen as a delivery platform for a lot of your content, despite the spinoff. Let's say Starz struggles to, find, streamership and new subscribers, and it could become more profitable to provide, your content through other streaming services, potentially exclusively. If that became the case, would you abandon your relationship with Starz for that opportunity?
Abandon our relationship. I mean, they're a great partner for us on the pay one deal. There's a bifurcated pay one deal as well. So I don't see us abandoning our relationship. I also think Starz is going to be in a unique position. I think they're going to be the bundling partner of choice because of Jeff Hirsch and his team, very focused on, underdeveloped demographics, including, by the way, women. So I feel like they're a great partner for us. I don't see that changing. They're buying a lot of library product. They're almost 20 million subs in the U.S. And obviously, we do a lot of non-exclusive licensing in every different format.
And one thing you can point to as well is that there's been examples with Starz, even in a consolidated family, where we've pivoted, and The Continental would be a great example of that. A television 3-part series that was a spinoff of John Wick, and originally being developed for Starz. And at the end of the day, there was a higher bidder, substantially better for win-win for everybody, and we pivoted, and that ultimately went to, I believe, Amazon and Peacock. So we've always followed an arm's length approach with Starz, even internally, and and also ultimately, created the greatest value for shareholders. So that's just a good example of how I think, one relationship will continue on in a very prosperous way. But some content will migrate to Starz, and some content will migrate to other third parties.
And even though Starz is going to own their own content going forward in most cases, or own a big piece of it, Lionsgate is the owner of the Power franchises. So we have a very vested interest, both companies, in having the spinoffs, the derivatives of the Power franchise, continue to work at Starz.
Thanks. We have 2 more from the audience here.
Hello. You've done very well with your library licensing. I think it's been compounding double digits. Could you just talk about how sustainable that growth can be going forward? It seems a little black boxy, but it's been doing very, very well. Thank you.
I think every day Jim Packer finds another place to monetize our library. We just did a minimum guarantee. I won't tell you the company, but it's such a great concept. It's basically taking some of our library product and helping train people in different languages. I don't know how many, how ways we can translate. I volunteer as tribute, but again, it was a pretty big minimum guarantee. And then, as I said before, we have 19, 20 different ways, whether it's the clipping side of the business or electronic sell-through or video on demand or sponsorships. I mean, I don't know if I have a son that plays a lot of Fortnite, probably too much, but he got into a good college, so that's all good. It's okay. But he, John Wick is a character inside of Fortnite. So obviously we're not doing that with them for free. So I think the library is going to continue. It'll have ups and downs based upon, big sales. I know they just had a big sale licensing The Chosen around the world. But I think the trend on that is very positive moving forward. And it's as Jimmy said, it's a great business for us. I think it's our biggest and most core asset.
Yeah, hey, and we just set 2 back-to-back trailing 12-month records. Now, we all know, using the sports analogy, it's hard to three-peat, but if you look at that library, anywhere from 800 to 950, significant trailing 12-month revenues quarter after quarter. So you can expect that to continue to be strong. And you also, some of the projects that we have coming up that Michael's talked about at Hunger Games, we got Twilight we're developing on the TV side of things, the John Wick spinoffs. All of these increase the value of our library, right? So you get the older films in your library that all of a sudden are in more high demand. So we're constantly refreshing that library every year with prequels, sequels, spinoffs, TV, and different aspects. So as well as new productions. So that library continues to be the strength and the crown jewel of the company.
Yeah, look, Jimmy and I talk about it all the time. We said the best thing we could ever do is just shut down the business and create some big dividend paying stock from our library. But that's not the business we're in. Where you want us to constantly enhance that library. But the library, any reasonable multiple, has that library worth more multiples of our enterprise value, not our market cap, our enterprise value.
Yeah, we have another one here.
Why aren't the margins in the library higher than 50%? I've always, over the years, I've heard bigger numbers. Like, what are the expenses that go against a library, sell a library content?
Well, the big one would be participations. So, right off the bat, you're talking about residuals, that's 7%. And then on top of that, you have partners on a lot of these big titles. And some of them in the library, not a lot, were just straight distribution fees. So we didn't put up any money. But for example, on something like The Chosen, where we didn't make it, we didn't put up a nickel, and we're getting a distribution fee off the top. It's a big number, but it's a smaller margin.
Yeah, and you're right in terms of the cash margins, 50% plus. You have a little bit of book value you're still amortizing off, but about 80% on average of our film and TV costs is amortized off in the first 18 months to 24 months after distribution. So again, for the most part, you burn that cost off, and these libraries go on and on. And generally, you just project out your revenue stream for 10 years, because that's kind of the industry standard. But they go on and on and on. Like Michael said, nobody puts baby in the corner. Dirty Dancing is just going strong, and every time it comes back up, it's selling for multiples of what it sold for the previous time.
We made a company. We had a goal. We wanted to be in business with Quentin Tarantino. I think he's one of the greatest filmmakers of all time. So we went after his library, skinny fees, but we distribute, I would probably say, 70% of his movies. But that gives us the opportunity to get close to Quentin and his team. And so I think that there are derivatives in the world of Quentin Tarantino that, if I were a betting man, I'd say that you'll see us talk more about that in the near future.
Great. Well, I think that brings us to time. So we thank you so much for joining us, and we hope to have you again next year.
Send our best to Mario, please. Thank you so much.
Thank you.
Yeah.
Appreciate it.
Thank you.